Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the closely related markets, and certainly the policy decision makers' impact on those markets. So we've had a lot of that here as of late. Gold's had quite a pop here off of the support lows that we've covered in the last couple of weeks based on your charts, Miles. And really, to me, the chart of the day is not the gold and silver chart, but the dollar chart. Kind of seems like we're reacting to that more than anything.
Yeah, I'm wondering, as a metals-specific YouTube show, if we don't start with the metals this week. I feel like that's sacrilege, but we've certainly done that before. Yeah, I think you're right. I think the dollar chart is the thing to look at. Yields are down across the board. The dollar index took a pretty significant decline today. We're back down to the lower end of the trading channel that we've been looking at. We had some compression coming up over the last few months that we broke below. I, again, was kind of assuming we might push back up to the top end of that, around that 106 mark on the DXY, the dollar index. But instead, we're down just above 100. Time of recording, it was about 100.5, coming off of about 104 just, a week or two ago.
Yeah, so we've seen a 3% decline in a short period of time. Silver up 4.2% today alone, on that news with the dollar, but other news as well. And we'll get into some of that.
Yeah,
but
and
that
gold
dollar
up like
index,
$30.
Yeah, and 50 off of its lows
right
from your previous chart. So we'll take that because gold's up 2.6% off of its lows with the 3% decline in the dollar index over that same period of time. And that really does make sense. You've done these beautiful charts going back over a year, and that inverse relationship with that cross, if you will, between the gold price and the dollar index.
Yeah. So why did the dollar drop today? I know the answer. I don't like it, but why? Why would that happen today? It couldn't possibly mean some arbitrary statistic that got pulled out of a hat and splattered all over Wall Street Journal and Yahoo Finance and everything else today, could it?
Such as what? Yeah.
So we had the seasonally adjusted June CPI, core price inflation numbers, come out here today on July, what's today, the 12th? July 12th, Wednesday. I pay attention to dates. Show coming out today on the 13th. So July 12th, June seasonally adjusted CPI numbers, 0.2% month-over-month increase. That's a 3% increase over the last 12-month rolling calendar. And the reason everybody's so happy is even though that seasonally adjusted CPI on a month-to-month basis is actually higher than it was in May, the June number 0.2, the May number 0.1, that 12-month rolling average is actually the lowest 12-month rolling average we've had since, I think they said, like August of 2021, if I'm not mistaken, or March, I can't remember.
Yeah, because you're absorbing some of those declines. You're starting to weed out the highest months and get into some of the lower months. There's no arguing that they've had some effect on the inflation rate in certain categories. But in other categories, we're actually seeing it get legs.
Sure.
And this whole adage, higher for longer, get used to hearing that true inflation is going to be higher for longer. And energy's telling us a big story. It's not just gold and silver. It's oil is telling us the story and other commodities. And the dollar index obviously is telling you the story. But what's hard for me to reconcile is why they've been pricing in this July 26th Fed rate hike of a quarter point. They say now it's over a 90% chance. That's strong dollar policy, and yet you're seeing the dollar turn down.
Right.
So try to make sense of that too. You try to find some headlines that can explain it away, and it's almost as if everything's upside down and backwards.
It's almost like Wall Street, because I'm sorry, there's 330 million Americans. Almost zero of them read that headline this morning and said, I'm going to go buy more Google stock. None of them. So what causes the price to go up? I'm sorry, this is where I get conspiratorial. This is Wall Street playing a game to try to drive prices up to a certain level in anticipation of an aggressive turnaround that they can short and profit on the other side of it.
Well, equities are going to play a role in that.
Absolutely.
We've seen this incredible, just on fire, hair on fire kind of equities market action, and I don't see it running out here as of yet. It's building some pretty bullish formations.
And we're still 6-7% off the top.
Yeah.
It's not like we're in breakout bullish territory. We still have a long way to go on the big indexes, on the S&P, to get back up to the previous highs. The NASDAQ, which has been tearing for months now,
Yeah,
is still significantly below the previous all-time highs. The Dow is significantly below the previous all-time highs. Gold is still below the previous all-time highs. Like, we still have a long way to go as far as expecting any type of breakout momentum and positive attitude towards the equity market. If we're thinking longer than 6 or 8 weeks, if we have anything beyond goldfish levels of memory, we're not in a good place.
Well, the key underlying fundamental, again, being the dollar. The dollar is far off of its all-time lows. So I'll flip that over. And it's the dollar lows that are going to come. If we close below 100, don't you see this sort of a free fall for 5 to 6 points and a major rally in gold? And
5 or 6
even
points?
The equities.
Easy.
Oh, yeah. And even the equities market should have a sustained rally from there. That will be one of those environments in which gold and the equities are moving in the same direction, which only happens about 25 to 28% of the time.
Dollar index on a global scale, because you think about the index, you always have to remember that that's the dollar compared to other currencies. Well, a 10 or 12 point drop in the dollar index is not completely unheard of. And now we're back to pre-interest rate level rising pricing.
And that dollar depreciation is why gold's at 1,958 as we record. I have so many clients, I'm sure you hear the same thing. Why is gold not at 2,500 an ounce? Why is it not an all-time high? And think about that. When the financial crisis hit in 2008, gold was sitting just below $700 an ounce, and it ran up to 1,925. Now that 1,925 is an apparent floor. That becomes now the new low, if you will, if these charts hold where you've got these target figures. That new low is indicative of gold doing its job in that period of time. And really what has happened as well is gold has actually increased its purchasing power. I love valuing things in gold. Kevin talks about it all the time. You talk about it all the time. We talk about it in conversations with clients. What does an ounce of gold buy? And that's how you can tell if gold is doing what it's supposed to be doing. Well, guess what? In 1972, it took 550 ounces of gold to buy a house. The average home price was $27,600 in 1972 when our company opened its doors. In 1985, when you had massive inflation like what we're seeing now, and Volcker was fighting the inflation, and it was the talk of the town, well, the average home price was $84,300. It had gone up that much. But it only took 258 ounces of gold. Why? Because it adjusted in that period of time. Well, guess what? In 2000, track me here, $119,000 average home price, and gold was only at $279 an ounce. So it went back up to 429 ounces of gold. So everybody talks about home prices now running rampant in this balloon, this big bubble in housing prices, and they're climbing again, unbeknownst to many people, but shockingly also indescribably, home prices are climbing again. And the average home price now, $436,800. Well, guess what? That's only 223 ounces of gold.
Yeah, and what if you live in Colorado where we do?
Yeah.
That number's a lot higher.
Yeah, but the 223 ounces of gold is half of what it was in 2000. It took over 429 ounces of gold to buy a house. So gold has far outperformed the housing market. The housing market, sadly, is up 375% in that period of time in the 23 years. Gold up 700%. So when you're talking about where to save for bubbles like this and monetary policy and fiscal policy, because it all comes down to debt and deficits. It's money creation from debt and from deficits. And that's the epicenter of the gold thesis is why do we own gold? And Morgan Lewis said this in our meeting Tuesday. You own as much gold as you can possibly own because of the fact that it's all about debt and deficits. Those aren't changing. They're just going up.
Sure. And that brings us back to where we open, because one of the things that has frustrated me for a long time when you're looking at what gold does and what purpose it serves on a 5, 10, 20-year basis, especially in the inflationary system that we have today, is because of our selfish nature as people and our wanting to be able to spend our money on what we want to spend it on, we focus on things like CPI, Consumer Price Index. CPI is a symptom. It's not the disease. It's a symptom of the disease. The disease is the gross overspending of the federal government far beyond the tax revenue that it brings in. So I was looking at the tax revenue over the last X number of years since way back, but I kind of went back to Clinton because that was the last time we had years where we were surplus. It's like it took him 4 years to bring in $500 billion surplus. And we're spending that over and above our tax revenue 3-4-fold over on an annual basis now at this point. So I was looking, estimated this year, I know the fiscal year ends in October, we're expecting about 4.1 to 4.5 trillion in revenue, 6.5 trillion in spending. So we're 2 trillion over again in 2023. Now that pales in comparison to, say, the 3.5 trillion back-to-back years we did during the COVID era.
Response, sure. I mean, those are anomaly years.
Yeah, those are anomaly years, but even still, we're looking at many years of presidents slowly increasing. I mean, the Bush era in the 200 to 300 billion a year, the Obama era in the 400 to 500 billion a year, the Trump era, if you look at the first 2 years, you're in the 700 or 800 billion a year. Well, now Biden era is probably going to be in the 1.5 to 2 trillion a year. So it doubled from there. And that's where the exponential growth comes out. And that's what causes inflation. Like, I think we have this weird misunderstanding of what inflation is nowadays. And I don't know if that's purposeful. I don't know if that's the bobbleheads on TV who don't have a clue what they're talking about, or they're just reading scripts, or if they're purposefully trying to mislead the average consumer in America, that the consumer price inflation is the disease. It's not the disease. It's the symptom of the disease.
Yeah, and that's why we can't get sucked into the minutia of chart technical support and resistance levels only. But as we transition into these charts, that's why it's important to know, where are we stepping in? Where are we adding to ounces? Over time, like you've said, you buy a couple times a month every month, right? So do I. We don't worry too much about, in a cost average standpoint, what is it doing? Because over our lifetimes, I mean, I've seen $35 an ounce gold, and now I've seen 1,958, and it's been as high as 2080, right? So it's doing its job. That's an incredible form of savings that far outperforms the equities markets. All that to be said, what are you looking at here with the gold prices now that we've bounced up to just under 1960?
Well, I mean, here's a perfect example of why I think you need to have a prudent strategy in place that brings in multiple entry and multiple exit opportunities as prices going one direction or the other. How long were we saying 1909? 2 months?
Yes, at least.
So how long was I also saying 1909 is a buy? It might not be the buy. We could see 1860. We could see 1800. So you look at it like rungs on a ladder, because what happened when we hit 1909? We tried to come back and touch it again. We didn't. It stayed above it. And now over the last week, we're up $60. So could gold still continue down? Of course it could. But what if it doesn't? Like, what if we're having our summer bottom in July, like we talked about last week?
Very normal.
Very normal. And by October, November, December, we're up at 2,500 gold. And this was it. This tiny, shallow, little 382 fib correction, shallowest possible correction we could have seen. And that was it. Like, that's kind of scary. You need good, solid, healthy pullbacks in any type of growth over a long period of time. And when you don't get them, that just gives you more and more credibility to the argument that we are in a screaming bull market in gold. If you can get rid of the goldfish memory and think a little bit longer than 6 months down the road.
So when will we know if we're seeing the resumption of the bull market trend versus just a little bounce in a bearish cycle, right?
Define the word no. When will we know? When we're at over 2,200?
Well,
no,
okay,
yeah, I know.
Let's say the next rung.
100% guarantee?
Next rung of the ladder. Where's the next rung of the ladder?
I'd like to see gold back up in the 2,000s. You know, we had the initial drop from, what was it, 2085, 2080, wherever the high was. We had to drop down to about 1960, right where we're at now, and it bounced between 1960 and 2,000 for a month. And then we had this last drop down to about 1909, which has been my target for, at least my first target for a while. So we need to get back above that chunk of time, like May, early June.
Yeah, we had a couple of false highs in June, right?
Yeah.
Around 1985 or something.
So I'd like
that.
to see us get above that. I'd like to see us maybe push into the mid 2000s, come back down and touch it. I always like to see, if you're climbing a flight of stairs, you want to see them put their foot firmly on the next step up. And that'd probably be as far as buying in during a rising market, which is a lot harder to do, especially when things start running away from you.
Yep.
That's probably where I'll make another one of those dedicated purchases, not my bi-weekly purchase into our vaulted plan, but one of those dedicated purchases.
Like the 1860.
Yeah, I'd obviously rather buy at 1860, and that's certainly still a possibility.
Sure.
We get a big interest rate rise this month, and like I was saying earlier, we could be seeing something where Wall Street is pushing the prices up in order to play a short position on a interest rate announcement, which the public will involve themselves in. The public isn't going to involve themselves in a month-over-month CPI announcement. Nobody cares. But they will involve themselves into their 401ks and their market positions based on what they see the interest rates doing coming directly out of the Fed.
I think people do care about the interest rate discussion. I think people don't understand it. They know in their heart of hearts that inflation is much, much higher than 3% that they'd like to state, right? It's out of control. They're feeling it in their month-to-month budget expense-wise, but they will totally believe and listen to the news on rate hikes because they know that borrowing costs are going to go up. And that's really what they're trying to do, is they're trying to clamp down borrowing, because it's the borrowing costs and leverage positions with purchases that help run the inflationary rate, right? Because that's also money creation. If you borrow in a fractional reserve lending system, if there's $1 million on deposit and they can lend out $10 million, that's $9 million created out of thin air. And that's leverage in a sense, but that drives the inflation. So when they can make employment drop, wages drop, borrowing drop, and stagnate the economy and throw us into a recession, which I'd say we're already in, then they can start to control inflation. It's sad that they drive inflation and then they also drive unemployment.
Right. So a couple more metals charts, just because that's technically what we do here, right?
That's right.
So silver, I had mentioned over the last couple of weeks, I kind of thought we were going to see silver sort of meander sideways somewhere between 22, 23. And then I checked the charts today, and what we do, like $1.10 in silver today, up.
Yeah, 4.2%.
So really aggressive move up in silver. Since you asked previously, where do I see potential breakout levels? If silver doesn't make it back down to that rising trend line floor, that certainly is a good signal that we're seeing strength. The next thing would be getting above the previous high back in June, which was 24.5. Maybe we see us up around 25 and change with the touchback down to that previous high. And yeah, if it works its way back up to the top end of that rising channel that we've had on our silver chart for the last month, I'm going to say we're probably looking at breakout territory on the way up. And now, again, we're in like September when this happens.
Sure.
We're in
right
rising gold.
Corner.
Yeah, we're in rising gold era right around the corner, 6-8 weeks from now. And my whole argument the last couple of weeks was I want to see us get into rising gold era when we're down at 1860 gold, or we're down at like 22 or 23 silver. What if rising era starts at 2,000 gold and 26 or 27 silver?
Could very well
So
happen.
the opportunities may have passed us. So I'm not trying to scare anybody. I'm not trying to say, hey, I can't stand when people do that. Like, call us now, count down for 20 minutes to call the 800 number. It's nothing like that.
No, I sent out a mass email to all my clients when we hit that 1910 figure. It's just an indicated advisable entry point, just like the 1860 would be.
Yeah.
That's not trying to create a FOMO, as you're kind of alluding to, at all. It's just advising and educating, and when it's a prudent opportunity to do that chunk instead of the semi-monthly acquisitions.
And then same, just because we're seeing the running theme, S&P broad index, S&P had a breakout move today also. So the S&P has broken above its rising channel. We're at around 44.75, I believe, on the S&P. We're 5-6%, 6-7% away from the previous highs. So we're getting there. Maybe it does it. I don't know. The move on today's announcement is so suspect to me. Like, we've seen it happen before. We've seen some arbitrary piece of news, some, I don't know, milk production announcement coming out of New Zealand that ends up affecting the US dollar some direction. And then 3 weeks later, something happens that tanks it the other way. And it just feels so suspect to me that this is getting set up for a big money play on an interest rate hike in a couple weeks. I hope I'm wrong.
I think you're right. David and Kevin will allude to the fact that our economy can't be as healthy as it's appearing based on stock market. People look at the equities markets as an indicator of economic viability. Don't do that, because the exports coming out of Japan, Korea, and China is something that they talk about. You really should listen to the McAlvany Weekly Commentary, and you'll get a perspective on the reality of our economy and why this too will be short-lived, and there will be a lot of money to be made by shorting the equities markets.
Agreed. Yeah, and this would be a great week to catch the McAlvany Weekly Commentary. If you're on YouTube watching right now, which I think is the only place you would be, it's going to be the video prior to this one that we posted up yesterday, so that's worth the time. So that's going to do it this week for Golden Rule Radio. We appreciate you stopping by. If you have any questions, feel free to give us a buzz. We can be reached at 800-525-9556. You can find us on our website at McAlvany.com. We are on Twitter at ICA Gold and Facebook at McAlvany Financial. Thanks for listening and have a great week.